RBI's income grew by 50% in FY23 and it did set aside 1.3 trillion rupees towards its contingency fund. Now, with this, its available realized equity rises to 6%. This is versus the Jalan Committee requirement of 5.5 to 6.5%. Now, the central bank has also reiterated that the economy will grow at 6.5%. So, Lata is here with some of the highlights of the annual report. Lata.
The annual report is basically interesting for the government to know how much dividend it will get, but that's already been announced, 87,000 crore. So the balance sheet has grown by 2.5%. The RBI balance sheet grows because it buys bonds and dollars, FX. Okay, now the balance sheet, that is the MTM gains, have come on gold. Currency and gold have been revalued up. We know gold prices went up and the rupee depreciated. So that's a 23% rise in its existing assets. But its foreign securities value has fallen by 1.65 trillion, it says, because as we know, US Treasuries, if you compare from March to last April to this April, the yields have shot up by about 500 basis points. So the price of the securities have fallen, and that is the mark-to-market loss that the Reserve Bank has suffered because it holds its FX reserves in US Treasuries and other foreign treasuries. So because the contingency fund went down, the Reserve Bank had to transfer 1.3 trillion rupees. That is its only expense. Otherwise, its income has done well. But because of this, the contingency fund had to be increased. Now, this is included in the calculation of the equity. So the equity of the central bank rises to 6%. Now, this is important. The Jalan Committee has said that it should be a minimum of 5.5 to 6.5% of its balance sheet. And up until now, last 3-4 years, the RBI has only kept 5.5% as its available realized equity. This is the first time it has raised it to the midpoint of the Jalan Committee recommendation to 6%, because this is a year when the central bank has made a lot of money. Selling FX, it has lent money in repo, so it's made money, and therefore it's given a generous dividend, but it could have given a dividend of even 1.5 lakh crore. It has chosen not to do that, but transfer more money to the contingency fund. That is the big takeaway, really, from the Reserve Bank annual report. Otherwise, its income grew by 47%. Like you said, interest income was the biggest earner, about 50% higher. Other income, which is largely FX gains, selling of foreign exchange, that grew by about 42%. And in terms of expenditure, the biggest was, like I told you, the transferring of money to the contingency fund, higher provisions. That rose by about 14%. The Reserve Bank normally spends a lot of time reviewing the economy in the annual report. The big takeaway is very positive. It sticks with its 6.5% GDP growth target for the current year. You know, most economists are at around 6%. So this is a very confident Reserve Bank. It says that, yes, there are dangers from global slowdown, but otherwise the macros are very strong. Current account deficit is down to 2.7% even for last year as of 9 months. And it is likely to be extremely benign given the services exports and the fall in commodity prices. It says that if you want to go above the 6.5%, then there is a need for medium-term structural reforms. On its own part, it is going to it points to 3 or 4 reforms. One is, as we've already discussed, the expected loss basis of banks making provisions. The other thing that you should expect from the Reserve Bank is a comprehensive review of the prudential framework. Prudential framework is, SLR, CRR, how much capital you have to keep. There is going to be a review of that, and some guidelines on the securitization of stressed assets are also expected. This is the promise from the Reserve Bank.
All right, Lata, thanks a lot for getting us all of the highlights from the FY23 RBI annual report. But with that,